Okay, so for this one, I will need to write the Petroleum Holding Fund. It stems from Petroleum Revenue Management Act. Okay, Petroleum Revenue Management Act. So basically, we are looking at the Petroleum Revenue Management Act. That one too, you can find it online. But like I said earlier, I will try and then collate them and then let you have it. With the Petroleum Revenue Management Act, as the name implies, petroleum revenue. You know, when we are looking at a fiscal regime of Ghana, which is royalty with state participation, we got to know some fiscal elements, even the ones that we just looked at in the unitization question. We are seeing royalty, carried interest, additional interest, surface rental charges. Last week, we looked at additional oil entitlement, training allowance, technology allowance, dividend, investment incomes, and the likes. So how are these revenues managed? And in fact, when these revenues are levied, how are they collated? And in fact, who even collates them? Of course, that one is Ghana Revenue Authority. But how, whatever that is purposed to be used, how is it used? And if they are invested, how is it invested? Okay, so that is what the Petroleum Revenue Management Act seeks to achieve. Let's take a look at Petroleum Holding Fund. When we talk of a holding is more or less like a collection of something coming together, but you can be able to identify them individually and then they come together like a holding company, basically having a lot of subsidiaries. Okay, so the Petroleum Holding Fund is also a fund and is sitting at the Bank of Ghana. And its main purpose is for the collection and then the disbursement of the petroleum revenues. I believe we know the petroleum revenues by now. That is its main function. It's a bank, it's a fund that is set aside. It is sitting with the Bank of Ghana purely for the collection of the petroleum revenues and then purely for the disbursement of the petroleum revenue. No other purpose can be used by this fund. It cannot be used for borrowing, cannot be used as collateral security or whatever, nothing. That is its main purpose. So, once it's sitting at the Bank of Ghana, then the question is, how is it disbursed? So let's look at the disbursement. But before we look at the disbursement, let's take a look at how even these revenues are estimated for. How are they estimated for? Because it's going to feed into our budget. So with the budget, let me look at the estimates. With the budget, we have a methodology called moving average. Okay, we are not going to delve so much into how it is being done. That's a bit technical. So we have, please hold on. Okay, so Mr. Nkrumah, we'll get there. When we get there, you begin to know what the petroleum fund is, the Ghana Petroleum Fund. There's a Ghana Petroleum Fund. It's not the same as that, though. So once the budget is being prepared, so we need to take a look at the budget, how it's being done, and it mostly use a 7-year moving average to be able to determine the budgeted royalties, carried interest, participating into, because they have the information, the respective oil fields and all those kind of stuff. So they know what is coming in. So we have a term called the benchmark revenue. The benchmark revenue are the expected oil and gas receipts. That is the budgeted. the expected oil and gas receipt. That is the budgeted. It's not the actual oil and gas receipt. By then, we make use of a moving average methodology to be able to determine the budgeted oil and gas revenue that are supposed to come in at any point in time. Okay. So when this is budgeted, obviously, because we need to have a budget, so we need to more or less capture all the budgeted amount. So when the actuals come in, then we need to make some comparison. Where there's a shortfall, then it means that we need to cushion the budget. And this is where the disbursement come to play. So I just want you to have in mind that, first of all, it is the budgeted that we begin to work with. When the actuals come, then we also follow the same cycle though. But the budgeted is the benchmark revenue, but net of equity financing. This is what I want to introduce over here. Benchmark revenue, net of equity financing. Okay, so the question is, what is equity financing? Remember, government has to contribute towards production costs to enjoy carried interest. Government has to contribute towards production development cost again to enjoy additional interest. That contribution is called the equity financing. So the equity financing is the paid participating interest by government. Okay, please take note of that. So when the actuals come in, this equity financing will be taken out. So when you read the Petroleum Revenue Management Act, you realize that at a point, they will begin to make this provision net equity financing that is going into the PHF. Okay, that one, it doesn't go into the PHF. It is paid by government, so it doesn't hit the PHF. Okay, good. So we come back to the benchmark revenue. Now let's begin to look at the flow. Benchmark revenue, let me put equity financing here. Then we have another one called ABFA, the annual budget funding amount. Then we have the Ghana Petroleum Fund. So the ABFA, a maximum of 70% out of whatever has been obtained here. That's when the actuals come in, but in a way, it's still part of the budgeting. 70% will hit the ABFA. Now, let's take note that the ABFA is mostly for infrastructural works in Ghana. That's what it's geared towards. A maximum of 70% of the benchmark revenue net of the equity finance will hit the ABFA. Then certain proportions out of the ABFA will also hit the Ghana Investment Infrastructure Fund and the likes. So it's purely for infrastructural works, which is being guided by a medium-term development framework. Okay, there's a guide that needs to be followed when utilizing or disbursing from the PHF to these respective funds. That's the ABFA. Then we also have the Ghana Petroleum Fund. So the Ghana Petroleum Fund, a maximum of 30% will hit the Ghana Petroleum Fund. Now, the Ghana Petroleum Fund also have the Stabilization Fund. And then it also has the Heritage Fund. So the Stabilization Fund to a maximum of 70% will hit there. Then the Heritage Fund to a maximum of 30% would also hit there. Now let's look at the Stabilization Fund. So the Stabilization Fund, as the name implies, it provides some form of stability. So as there is a budgeted oil and gas revenue, when the actuals come in and is compared with the budgeted and there's a shortfall, because as we are budgeting, obviously there's an end goal. Perhaps we are going to use to develop roads and all those. I'm talking about the ABFA. That's for mainly for infrastructure, work, build hospitals and all those kind of stuff. So if there is a shortfall when the actuals come in, the question is, how will we be able to make up for the shortfall? So that is where the stabilization fund comes to play. So the stabilization fund, there are procedures that would need to be undertaken to withdraw from the stabilization fund when there is a shortfall. And the shortfall is mostly assessed on quarterly basis. So the quarterly ABFA that you are supposed to obtain, and then the quarterly actual ABFA that comes in. So when there is a shortfall, then it means that we need to withdraw from the stabilization fund. And that is a maximum of 30% from the GPF into the stabilization fund. But when it comes to the actual amount to withdraw from the stabilization fund to cushion the ABFA, which is the budget, that one, there's a procedure that needs to be undertaken. When we go through the lecture slides, you get to know how it is done. With the Heritage Fund, a maximum of the GPF or hits the Heritage Fund. The Heritage Fund is more or less for our future generations. So it's a fund that is set aside for investment. However, they will want to take a look at it, but it's purely for our future generations. It's not even for our next 10 years. It's a long way forward generation. It's purely into the future. So that in case of anything, government can easily fall on that. So that is the Heritage Fund. It's for posterity. It's not for now. Okay, that's the Heritage Fund. But bear in mind that we have another fund. Okay, that should, in case the oil and gas reserves of a particular field gets depleted, should in case it gets depleted, that is where the Ghana Petroleum Wealth Fund comes to play. I think Mr. Nkrumah was asking about that. That is where it comes to play. So when it gets depleted, then it means that that particular reserve is no more bringing in oil and gas, the tax revenue. So the Heritage Fund and then the Stabilization Fund at a point would need to be dissolved. So when we get into the slides, we'll take a look at it more. Now let's delve into that. So here with the Petroleum Revenue Management, like I said earlier, it's being regulated by the Petroleum Revenue Management Act. I think 2011 Act 815. And with the PHF, when you take a look at Section 2, you get to know that it's a fund that is established at the Bank of Ghana and it's purely for receipts and purely for disbursement. Okay, so any other purpose that is being used, then it is not in sync with the Act. Now, these are the revenues that are deposited in the PHF. We have royalties carried and participating into net of equity financing cost. The equity financing cost is the share of the National Oil Company. So that is GNPC. The cost that is being paid by the National Oil Company. Okay, so that is what I was referring to earlier on. That is the equity financing cost. Dividend from GNPC, the corporate taxes, additional oil entitlement, surface rental, investment income derived from the accumulated fund. So these are all, let's say, all the mainstreams. The oil and gas streams, the revenue streams will have to hit the PHF. Now, sometimes government may elect, when you look at the fiscal element, additional oil entitlement, when there is a windfall profit or a supernormal profit that it was not really captured, but in reality, there's now an excess. So it sometimes can be given in terms of the oil or in terms of cash. So in an instance where there is such a scenario, but government wants it in terms of cash, so it means that they would need to take a look at the value of that barrel on that specific day that the government is receiving the oil in US dollars. And this would be reported or recorded by the Ghana Revenue Authority as payment for the Petroleum Holding Fund. So when there is a sale, because there could be a sale within 60 days after the receipt of the petroleum. So when there is a sale, then it would then go into the petroleum fund. That is the cash that has been received. So although GRA would record it, but the cash is not in the PHN. So it is when it's sold that it will be recorded. Additionally, remember, GRA recorded on the day of the receipt of the petroleum. So if the dollars have changed, the exchange rate have changed, then meaning GRA will need to equally make an adjustment as well, because it is the actual PHF, the actual deposit in the PHF, that's what's going to be taken. Section 5 looks at prohibition for the use of the PHF. Like I indicated earlier, it cannot be used as collateral for debts, guarantees. It cannot be used as credit. No borrowing can be done. Its main purpose is for collection and disbursement, or let me say receipts and disbursement. So in an examination condition, you can be asked the prohibition of the use of the PHF, and these are what you need to provide. Let's look at how the Ghana National Oil, GNPC, how they are funded. They are the National Oil Company. Okay. So according to Section 7, subsection 3 of Act 815, which is the Petroleum Revenue Management Act, it says that the funding of the National Oil Company for the period not exceeding 15 years after the commencement of the Act, and I think it was in 2011, as amended, the cash or the equivalent in barrels of oil. So the GNPC would also need to be funded from this oil and gas revenues. Okay, and the funds that are ceded to the GNPC must, is the net of the carried and participating interest, that's the net of the equity financing cost is taken out, like I said earlier. But after that, whatever that is given to them must not exceed 55% of the inflows that came in after the deduction of the equity financing cost. So which means that GNPC has up to about 55% of the net amount to be given to them. However, these would be reviewed every 3 years, taking a look at the programs or the activities that GNPC is doing with the monies that have been given to them. It will be reviewed every 3 years. Section 8 takes a look at transparency and accountability of the petroleum receipt. Yes, the petroleum receipt hits the PHF, but how is it accounted for? And then whatever that is being used also, how is it accounted for? So the receipt of the petroleum revenues shall be published by the Minister of Finance in the Gazette, and it must be in at least 2 state-owned daily newspapers. And this must be done every 30 days at the end of every quarter. And this published receipt must indicate the total petroleum output that has been lifted, that is the quantum that has been produced, and then the reference price as well as any other information, so that the citizens of Ghana would be, they will be in the known of whatever that is happening. So now let's look at the allocations and then the disbursement. We've looked at the receipts. We need to take a look at the allocations and then the disbursement. But first of all, we need to take a look at the benchmark revenue. Like I indicated earlier, the benchmark revenue is a projected revenue receipt from the oil and then the gas, and is derived from a 7-year moving average. As for us, we are not really going to go into that, but we need to have it at the back of our minds. It's basically the expected current receipts from the crude oil plus expected current receipts from the gas, expected dividends from the National Oil Company, the corporate income tax, the surface rental, and any other revenue that has been identified under Section 6 as amended. So bear in mind that the Petroleum Revenue Act has even been amended. I think that would be 2015. Let me see. Yeah. So this is the act itself, 2011, but some portions were amended in 2015. So that is how come I've indicated amended first schedule of acts, but that one is Act 893. Yeah. So it follows a medium-term development framework. Okay, that is the benchmark when it's been allocated to the ABFA. So let's go to the ABFA. Please, are you following?
Yes, please.
You think
Yes.
this one is more of reading it, so it's a bit boring.
So, Madam Abigail, whilst waiting for Bill's books to be ready, can we get some of the slides? I
No,
just saw
unless
the
you look at the videos, because everything is in the book, so we don't give out the
slides,
teaching
but the
note.
slides his slides are still not ready. And some of us we like physical books reading than reading on the phones and things.
Mm.
So
You
I don't know.
can take a look at the video whilst you are listening to the video, so that, because sometimes even though you may have the book, you need the teaching aspect of it. So
Yeah,
please
I
bear with
understand. But
us
then
for the
if you don't,
meantime.
yeah, okay. So we hope that the books will come out quickly because
Yeah, that
some
one
of us
we are.
this one is not helpful to us unless we see hard copies of materials
Oh,
to
okay.
read. Mm.
We are seriously working on that. So that one. That's why can we also try our best to bring in the videos as early. It seems sometimes the video can delay because of the demarcations. We need to know at what point we need to cut it and at what point we need to continue. So please bear with us on that one as well. Yeah. Thank you very much. So with the ABFA, we already know the benchmark revenue, the equity financing. Now we are at the ABFA. The ABFA, like I said earlier, per the Act, is purely for infrastructural purposes. Okay. And this is where actually it even fits into the budget. Okay, so it's a predetermined percentage of the benchmark revenue. Basically, that is about the ABFA, but for its use, it's purely for infrastructural activities by the government of Ghana. So this is just a model. Once you are able to capture this model, you'll be good to go. Okay, because sometimes an examination condition, you may get confused, especially with this 70%, 30% thing. But once you have this model, you'll be fine and be able to explain it as to the requirement of the examiner. Okay, so looking at section 18, a maximum of 70% of the benchmark revenue. That means that not more than 70%. Okay, so it is allocated to the ABFA, is guided by medium-term development strategy. I think I've said all that, so I don't want to go into all that. But it's subject to review every 3 years. That is the medium-term development plan. Okay. But then the ABFA is used as collateral for debts. You see, we look at the prohibition use of the PHF. That one is for receipts and disbursement. You cannot use it for borrowing or anything. But for the ABFA, whatever amount that is in there, depending on agreement with whoever, we can use it as collateral for debts. Okay, but the ABFA, once it's purely geared towards infrastructural works, its main use is to maximize economic development, promote equity, ensure that all the regions in Ghana are okay. They have the hospital, the basic facilities, and all that. because it's guided by a long-term national development strategy. Now, these are some of the areas that the development plan looks at. We have agriculture, agribusiness, human resource development, education and health, water and sanitation, the road, rail and port infrastructure, rural development, and the like. So these are some of the areas that we get to look at when it comes to the ABFA. With the Ghana Petroleum Fund, it's a maximum of 30% from the benchmark revenue net of equity financing. So that will hit the GPF, and it is out of the GPF that we distribute to the Heritage Fund and then the Stabilization Fund. So let's look at the Ghana Stabilization Fund. This is what will cushion the ABFA when the actuals come in and then there's a shortfall. So it helps to cushion or sustain public expenditure capacity during periods of unanticipated petroleum revenue shortfalls. So let's look at the withdrawals. And this can be found under Section 12 of Act 815. So where petroleum revenues collected in any quarter fall below 1 quarter, remember, we'll take a look at it on quarterly basis. So where petroleum revenues collected in any quarter fall below 1 quarter of the annual budget funding amount for that financial year, withdrawals may be made from the Ghana Stabilization Fund. So let's look at how the withdrawals are done. The allowable amount to be withdrawn, this is the criteria, shall be the lesser of 75% of the estimated amount of the shortfall for that quarter. So which means that we need to take a look at the shortfall for that quarter by comparing the budgeted and then the actual for that quarter. Or then you look out for the 75% of it, or 25% of the balance standing to the credit of the Ghana Stabilization Fund. So obviously the fund is going to have a running balance. So if you want to take a look at the criteria, you just look at the opening balance, you multiply by 25%, and then you are good to go. So let's look at an illustration over here. But before that, the purpose of this fund, of course, is to alleviate shortfalls in the actual petroleum revenue, and then it can also be transferred into the contingency fund or for a debt repayment. So these are some of the uses of the stabilization fund. Let's take a look at the illustration over here. So here, the ABFA for the year 2014 was 125 million cedis. That's the ABFA for the year, not quarterly, for the year. The second quarter actual petroleum revenue stood at, let me say, almost 17.8 million. As 70% of the petroleum revenue is earmarked for the ABFA. The following is relevant. At the beginning of the year 2014, the stabilization fund stood at 110 million cedis. Calculate the amount to be withdrawn to support the ABFA. We know that for us to be able to know whether we even need to withdraw. So these are some of the issues. The fact that you are asked to calculate the amount to be withdrawn doesn't necessarily mean that indeed there will need to be an amount that has to be drawn. You need to actually check if there needs to be a withdrawal. Okay, for us to check, we need to take a look at 75% of the shortfall or 25% of the opening balance on the stabilization fund. So we already have the opening balance, which is okay. Now let's take a look at whether there's a shortfall or not. And we need to compute it based on a quarterly basis. So for the quarterly ABFA for the year 2014, we're only giving the yearly amount. So we need to divide by 4 to get a quarter, which is 31.25 million. Then in the second quarter, we were given the actual petroleum revenue, but we were not given the ABFA. And we know that Okay, this one was even given the question, so that is fine. The question indicated that 70% of the petroleum revenue is earmarked for the ABFA. So meaning we need to find 70% of actual revenue, which is 70% of the 17.8 million, which is giving us 12.5 million. So the actual 12.5 million, then the budgeted 31.25 million. There's a shortfall of 18.75 million. So if that is the case, then we need to look at the lesser of it, which is 75% of the shortfall or 25% of the opening balance. So 75 of the shortfall is giving us 14 million. I'm just approximating them. Then 25% of the opening is going to get 27.5 million. So the lesser of it is going to be the 14 million, which means that for that particular quarter, the stabilization fund, we can withdraw the 40 million from the stabilization fund and top up for the actual. Then government can be able to handle all the infrastructural activities. Please, are you getting it?
Yes.
Okay. So we look at the Ghana Heritage Fund, which is Section 10 of Act 815 as amended by Act 893. So with the Heritage Fund is purely for posterity. Okay, it's purely for the support of the development of our future generations when the reserves have been depleted. When the reserves have been depleted. So, you know, it can take a number of years before the reserves have been depleted, meaning there's no more oil and gas deposits in that place for us to produce. So, once that reserve is depleted, then we will need to be able to look out for the Heritage Fund, and it's going to be for the development of our future generations. But like I said, when the reserves are depleted, it also connotes that the Ghana Stabilization Fund and the Ghana Heritage Fund would need to be dissolved, as in individual funds, and they will be, however, consolidated into a single fund known as the Ghana Petroleum Wealth Fund. So this is what Mr. Nkrumah was asking. So which means that all the various petroleum agreements, we need to able to identify them, because not all of them or not all the reserves will be depleted at the same time. So as and when it gets depleted, then we need to be able to identify the stabilization fund and then the Ghana Heritage Fund from those reserves that are depleted and consolidate it into the Ghana Petroleum Wealth Fund. So Mr. Nkrumah, basically, that is what the Ghana Petroleum Wealth Fund seeks to achieve. So we've been able to look at the allocations and then the disbursement, but we need to consolidate it as one. For the receipts, it's not really a big deal, but for the disbursement, it's a big deal. So Section 16 outlines how the disbursement is going to be done, and it's a matter of priority. The first one will go to the National Oil Company. So with the National Oil Company, like I said, when the actuals come in, the equity financing does not hit the PHF. It will still go to the National Oil Company. That is how come the Act, when we were taking a look at the funding of the National Oil Company, they made mention it is net of the equity financing cost, because the equity financing cost will go to the National Oil Company. Whatever contribution that they made, it will hit back. Then aside that, any other amount that they would want to be given per the agreement or per the Act, they will then begin to take a look at it. Then the second disbursement is the ABFA. The ABFA is the same as the budget. So it goes in the consolidated fund in support of the national budget. So you realize that we are even following the model. Then the third one is the Ghana Petroleum Fund. So for further disbursement into the Heritage Fund and the Stabilization Fund. Then once all these are said and done, if there's any other refund or any other thing that government want to do, then they can do it. So as there are budgets and as there are actuals, there will definitely be some reconciliations. That is according to section 15. So when reconciliations are done and there's an excess, when reconciliations are done and there's an excess, one would ask what happens? Okay, it will follow the same procedure when there's an excess. So it will still hit a maximum of 70% will go to the ABF, a maximum of 30 will go to the GPF. So it follows in that order and on and on and on. Basically, that is how it goes. So this is the transfer of the excess according to section 23 as amended. As usual, when it comes to the Petroleum Revenue Management too, there are also some key players over here, of which one of them is the Ghana Revenue Authority, the Bank of Ghana Investment Advisory Committee, the PIAC, the Auditor General, the Joint Management Committee. So please make time and make sure you read on all these players. They are very, very key. And like I said, don't enter the examination room without reading on them. Okay, so basically, that is it. We also have some terms. You know, when you talk of cash call, because a joint venture, at a point, there's going to be a cash call where all the operators would make some contributions, of course, based on their proportionate sharing interest. Then the government take is the total revenues accruing to government. That is the government take. Then sterilization, an instance where government will want to invest outside the country. Just so looking at the economic status of the country, they would want to invest outside. That is called sterilization. We also have types of wells. And the examination conditions, sometimes you can be asked to differentiate between, we have something called a wildcat well. You can have an appraisal well, you can have a development well, a production well. Okay, so a wildcat well is the same as an exploratory well. It's a well that is drilled to discover a new oil or gas reservoir in an unproven area. Take note of that, in an unproven area. Okay. Now, when there is a discovery, then it then begins to look like an appraisal well, because once there's a discovery, then it means that certain evaluations have been made. But a development well, that one is a well that is drilled in a proved area. So once it becomes an appraisal well, then it's likely to develop into a development well. Okay, it's likely to develop into a development wells. Then we have the production well. So for production well, obviously, it's a well that is drilled to be able to produce the oil and then the gas. Now, when you see a dry well, you have to know that it's a well that has no oil or it has no gas. So this is just an illustration that I brought on board for us to know the reservoir. Sometimes when we say the oil is sitting in a reservoir, when we say there's a well, these are some of the things that we are talking about. So these are some definitions that you may want to take a look at. Sometimes this short, the right short nose thing can add the difference between surface right, surface rental, the difference between a contractor and a subcontractor, the difference between an oil drilling, the difference between an oil well. So these are some of the issues that you will need to take a look at. Okay, please, do we have any questions up to this point? Hello, are we there?
Yes, please.
Yes, we are there.
Is there any question? Okay, so okay, so we'll take a look at accounting approaches. Let me talk a bit about the accounting approaches. For the tax issues, I think I'll have to delve into the Act. Then I can be able to speak to them. So for the accounting approaches, we need to understand it because the tax starts from where the accounting and then the auditing ends. Okay, so you need to understand the accounting methods. It's very, very important. And it's also a highly specialized industry, so you need to get the accounting approach. But basically, we have two main approaches. We have the successful efforts accounting method or the full cost accounting method. Now, with the successful effort accounting, as the name implies, it means that something needs to be successful, right? So it's actually connotes that there should be a commercial discovery. So such a method is a school of thought that goes like, okay, so we are in this sector to make profit, okay? It's a business. So if any effort does not lead to a successful discovery, then we would rather expense it than capitalize it. When I say expense, you know, there are financial statement. We have the balance sheet or the statement of financial position. We have the profit and loss account or the income statements and comprehensive income. I mean, let me stick to these two. So when we say expense, then meaning that it's going to pass through the income statement. When we say capitalize, meaning that it's going to pass through the statement of financial position, preferably is going to form part of the asset side. That's the capitalization I'm talking about. Okay, so it's successful effort. And when you look at the cost streams, or let's say the phases that we look at the beginning stages of this lecture in the upstream sector, please, in this side, we are focused on the upstream, not the midstream and then the downstream. Okay, so we have the acquisition phase, we have the exploration phase, we have the development phase, and then we have the production phase. Okay, so if the successful effort school of thought is saying that we would only capitalize the cost that will lead to a successful effort. So what are those costs? Now, for acquisition costs, it will definitely be capitalized because you need to acquire it. I mean, acquire the license before you can undertake any activity. So for that side, the purpose of the acquisition is for the license. So once you incur such a cost, then of course, we are moving forward. Then we come to the exploration phase. It is the exploration phase that is actually the determinant factor because acquisition will always be capitalized. Development will always be capitalized because once an operator gets to the development phase, trust me, then it means there's a commercial discovery. If there's no commercial discovery, you would just relinquish the license. So when it comes to production cost, let's take a look at this at it this way. The oil field is like a biological asset, okay? So you will need to prepare the oil field to be able to use the asset. The usage of the asset is the production of the asset. So whatever cost that is being incurred to be able to produce the oil would be capitalized. So the acquisition cost will be capitalized. The exploration cost ideally will be capitalized. And the development cost to be capitalized. But the production cost would be a periodic expense because all the cost that has been incurred, the initial cost, preparing the field, installation of the machines, drilling wells, all those kind of stuff, they are just preparing the oil field for usage, which is the production. So analytically, analyzing these phases, majority of the cost will be incurred at the pre-production phase. Then the cost that is going to be incurred during the production is more or less like operational expense. Okay, so in both methods, the production cost is a periodic expense. It will always be expensed in both methods. So that means that the exploration phase is the determinant factor. Okay, so sometimes, well, it depends. The fact that one is undertaking an exploration does not mean that it will lead to a commercial discovery. It is at the exploration phase that we are just searching for the oil, whether it exists in commercial quantities or not. And if it exists, does it even exist in, yeah, I just even said that, does it even exist in commercial quantities before development can even come, and then we can be able to develop the oil, the field. So that is how come I made mention earlier that once the operators are in the development phase, then it means there's a commercial discovery. Again, at the exploration phase, once any activity is undertaken, there could be a dry well, or there could be a well that is having a reservoir. So for the successful effort, if the exploration does not lead to a successful discovery, we need to expense that exploration cost. It will pass through the income statement. But if it leads to a successful discovery, then we'll just capitalize it. So we'll capitalize it alongside the acquisition cost, the development cost, and then the exploration cost as well, under the non-current assets baseline. But bear in mind, you would see sometimes geological cost, geophysical cost. All these things are there. They are all part of it. Okay, so the fact that you are seeing here, you are only seeing acquisition, exploration, and development, doesn't mean when you see geophysical, geological, and those kind of costs, as long as it's related to pre-production phase, please, you need to take note that it's part of the pre-production phase. Okay, but the determinant factor is the exploration cost. For the full cost, as for them, they are of the view that we are in the oil and gas business. So as for us, whether the exploration leads to a successful discovery or not, we will capitalize all the pre-production cost. So just by analyzing, you realize that at a point, if let's say you are an investor and you may want to study the financial statement of an upstream oil and gas company before you actually depict whether you want to invest in them or not, you need to actually check the accounting method that they are using. Because when it comes to the full cost like this, and they are of the view that whether it leads to a successful a commercial discovery or not, they will capitalize, meaning they are going to have a very huge asset base. Comparing to successful effort accounting, all other things being equal. Okay, they may not have a huge asset base if the exploration at some point did not lead to a commercial discovery. Likewise, when it comes to the income statement, the full cost people, they are going to have their expense not going to be jumping as much as the successful effort, because if there's no commercial discovery at a point, then they will need to be expensing. So these are some of the things that you want to take a look at. But the choice of the accounting method does not influence the treatment of the tax issues when it comes to the upstream sector of Ghana. But it is just for you to know how their income statement is being prepared, because it's the income statement that we use in assessing them for taxes. So for instance, if you see that exploration cost has been expensed, when it comes to capital allowance purposes, how are you going to treat it? That is where I'm coming from. Sometimes students think that because it has been expensed, so it is not an asset. So they will not provide the capital allowance or they will not compute. But the answer is a big no. The Act says that when it comes to, we'll be looking at capital allowance window, but then the Act says that for the mining and then the oil and gas sector, capital allowance is not granted until production takes place. Until production takes place. So which means that if it's for a number of 7 years and production has not been taking place, but then they have been able to explore, they've been able to develop, which means that they have incurred the pre-production cost. It would just be accumulated over that number of years. So when production takes place, then the capital allowance would be granted. So if at a point the accounting or the accountant is expensing an exploration cost, it doesn't mean that it is not part of their asset. Because of the accounting method they are using, it does not form part of the asset base. But for we, the tax people, that's not what the Act is saying. So we need to add it as part of the asset base, and then we compute the capital allowance. That is what I just want us to draw our minds on. But moving forward, we'll be facing some questions, and then you may get confused along the line. So let's look at depletion, depreciation, and amortization. For depletion, I believe we've been meeting it, the reserves getting depleted. So depletion is mostly associated with a reduction in the value of the natural resource. And depreciation is associated with a reduction in the value of the tangible assets. And amortization is associated with a reduction in the value of intangible assets. Sometimes an examination condition, you may be asked to write on them or differentiate amongst these three concepts. Okay, so let's take a look at this illustration. So here, the following information relates to Petro Exim Limited, which has been in the oil and gas industry since beginning of 2017. Petro is registered with 5 million ordinary shares issued at $1 per share. 35% of sales revenue is still unpaid as at 31st December 2017. Cash and bank balances as at year-end amounted to $2.9 million. Oil production for the year was 850,000 barrels, selling at $50 per barrel. Gas production for the year was 250,000 cubic ton, selling at $10 per cubic ton. Then production cost estimated at 60% of actual production. And these are the other costs. We have acquisition cost, which includes geological cost of $125,000, which is $575,000. So here the total acquisition cost, including geological, is $575,000, but the geological cost out of the $575,000 is $125,000. Then we have the DDA. That's what I mostly call it. But here is ADD, but I call it DDA. So we have 10%, and it's based on acquisition cost. Then we have development cost, which is $1.525 million. Then you realize that here they are saying exploration wells into brackets, 25% of which were dry holes. So it means that dry hole, meaning that 25% did not lead to a commercial discovery, even though the total cost is $2.25 million. We have to prepare the income statement and a statement of financial position. Okay, so here I just did an illustration and Excel sheet. So let's just take a look at that. Please, can you all see the screen?
Yes, please.
Yes.
Yes.
Okay, then again, another tidbit. Whenever you are solving a computation question, kindly, if it involves something like this scenario or an assessment of a tax, those kind of things relating to a corporate entity, always bring the name of the company, then the requirement that you are being asked to. This one is we are preparing the income statement and then the SOF. So you bring on board income statement for the year ending 31st December 2017. Always remember to bring your currency sign. Currency sign is something that sometimes we forget. Bring your currency sign, either in dollars or in cedis. Don't think that when you forget the currency sign, what you are, we don't know what you are saying. Okay, so bring on board your currency sign. And the workings, it depends on you. You may want to do the workings alongside, like that is in your solution, or you do your workings on a separate sheet. You do your computation or your solution on a separate sheet. And of course, kindly have a good, clear handwriting, because you may be writing something good, but if the exam, the marker cannot see, you can imagine what's going to cause you. So please make sure your writings are highly clear. So let's look at the income statement. Here we have the successful effort and we have the full cost. So income statement, of course, we need to do our revenue and our expenses. Then we cut the difference, we get our profit. That's all. Okay. We already know that the oil and then the gas, we already know their quantum. So you multiply the quantum by the price, you get a value. That one, it doesn't change. It's the expenses that is going to change. So with the successful effort, the way the question is, you can make your own assumption. I assumed that the geological cost did not lead to a commercial discovery because of the exploration well over here, which is 25%. So someone can also assume that if 25% of the exploration did not lead to a commercial discovery, then maybe 25% of the geological cost too may not lead to a commercial discovery, because geological cost, they are all under the exploration cost. But I assume the whole thing just to make it easier. So if it's led to, how do you call it? It did not lead to a commercial discovery, sorry, then we expense it. So that's what's happening over here. But full cost, as for them, they don't really bother. Once it's a pre-production cost, it is going to be capitalized. So now let's look at the DDA. The DDA is based on acquisition cost. So over here too, I'm assuming that this 575, this is what the examiner is saying, that the total acquisition cost, because the thing is, under the successful effort accounting, if I'm assuming the 125,000 is expensed, then I might as well take it out before computing the DDA. But I took the full 575,000, which is giving us 5,750. So what I'm trying to say is that an examination condition where you need to take a stand, feel bold and take a stand. Just that you write your assumption and you are good to go. So we have the exploratory dry holes is 25% of the total exploration cost. Since it's a dry hole, meaning that under successful effort is expensed, but under full cost is capitalized. So here is 0. For production cost, I think it's 60% of the revenue, yeah. So that one, it's cut across. Production cost, like I explained earlier, is a periodic expense. Okay, so you just need to expense it. So once you are done, you get a difference. You realize that the full cost has a higher profit than the successful cost. So let's look at the statement of financial position. So the acquisition cost, that is supposed to be capitalized. You take out the geological cost, which is the 450, and then the full cost to maintain the 450. But we bring in another line of the geological cost just to break them down. Okay. So an examination condition, try and break down your answer, because the marks is according to tick marks. So don't try to fuse everything in one. Try and break them down. Okay. Then the development cost is always and always capitalized because it leads to a successful discovery. The exploration wells, it is 75% that is going to be capitalized under the successful effort. By the full cost, it will be full cost that is going to be capitalized. Then we less our DDA. So the asset base for full cost is higher than the successful effort. Then of course, we'll have our receivables over here is the same. Then we have the equity side. There are no liability aspects. So here, the asset is equal to the equity. So the stated capital and then the income surplus, because there are no, how do you call it? Previous or running balance from the income surplus or, yeah. So we just take only the profit and then we bring it on board at the equity side and then we are good to go. So you realize that the asset base is higher than the successful effort when it comes to the full cost. So basically that is it. Please, do you have any question on this? Hello, are we there?
Yes, please.
Are you getting loaded?
Yes,
Very,
please.
very well. We are getting loaded.
Okay, that's good. I like it when you get loaded though. Anyway, so I'll be finishing very soon since you have tax audit at 10. So I'll just wrap up at a point. I don't know, maybe when we do capital allowance, then we can wrap it up. So we are now at the taxation aspect. When you look at the Income Tax Act, we have a section for specialized industries. I think part 6 being I. So you begin to see petroleum and mining over there. I think petroleum spans from 63 to I think 76. Yeah, 76 or so. At a point or 71, one of the 70 figures. So section 63 looks at the principles of taxation in petroleum operations. Okay, and please, I would entreat that you pay close attention over here. And of course, if you want to make any submission, just feel free because I believe we have more tax people here. So just feel free and make a submission and then we are good to go. So section 63 talks about the principles of taxation. It just introduces it to more or less the background issues. Okay, so here we are being introduced to accessible income. So you find it under section 3, subsection 1 of Act 896. That's the Income Tax Act 2015, Act 896. So the accessible income is all the incomes of a person. A person in tax can mean a corporate entity, a trust, a partnership, or an individual. A corporate entity, a partnership, a trust, or an individual. Okay, so when you hear person in tax, that is what it means. So from employment, business, or investment. And for the purposes of oil and gas, when ascertaining the accessible income of a person, in this case, we are talking about a corporate entity, that person shall treat each separate petroleum operation as an independent business and shall calculate the tax liability of each independent business for each year of assessment. The question is, what is a separate petroleum operation? Okay, so remember earlier on, someone asked the question, okay, I may not be able to pull it up right now, but so let me just go straight to the question. I mean, to explaining the separate petroleum operation. You know, the petroleum operation is a joint venture. So one operator can have access to several licenses or petroleum agreement or blocks, can be operating in different blocks, like the unitization question that we went through. You see, TC had a stake in West Cape 3 Point and had a stake in offshore Cape 3 Point. So how would TC be assessed for tax purposes? Again, TC and Agyekum were operating in West Cape 3 Point. So how would TC and West Cape 3 Point be assessed? Sorry, and Agyekum be assessed for West Cape for taxes under West Cape 3 Point? So you realize that one operator can be operating in different, with different agreements. At the same time, two operators can be operating under one agreement. So what you need to take note of is that when it comes to one operator operating under different petroleum agreement or different licenses, each of the blocks or the agreement or the license will be assessed for tax purposes separately, even though they are all under TC. But we'll assess TC and West Cape 3 Point, then we assess TC and offshore Cape 3 Point. They will all be treated differently. Likewise, TC and Agyekum will be treated separately for tax purposes under the same West Cape 3 Point. Okay, then again, in the upstream petroleum operations, the main phases, let's take out all the other phases, but the main phases are exploration, development, and then production. And in each of the phases, there is likely a work program that needs to be followed. When you check the Model Petroleum Agreement, you begin to see exploration work program, development work program. Okay, when it gets to the development, there is a plan that is being built and it will need to be approved. So we have a term called the same separate petroleum operation or the separate petroleum operation. Same separate petroleum operation, meaning that it is with respect to the same oil field that the development plan is being approved. So once it is with respect to the same oil field, it's a same separate petroleum operation. So we normally demarcate it as prior the approval of the development plan and after the approval of the development plan. Now, because one operator or two operators or however can be operating under several licenses, you realize that at a point there will be different separate petroleum operations per their proportionate sharing interest. So, for instance, Deepwater Tunnel and West Cape 3 Point shall be treated as separate petroleum operations. Indeed, they are different oil fields, but they will be treated separately. Activities of persons in petroleum operations and other activities shall be conducted at arm's length standard or basis in accordance to Section 31. Section 31 deals with the arm's length standard. Basically means that whatever transactions, even though it's a joint venture arrangement, whatever transaction that happens over there must be treated as if they were treated amongst independent persons. Basically, that is what it means. Okay. Now, we are still on the general principle. So because we are dealing with the tax law, I'll be reading quite a lot over here. Here it says that the transfer of an asset to or from a separate petroleum operation. So sometimes you may want to do some transfers amongst themselves. It shall constitute an acquisition by the recipient and a disposal by the transferor. This is what the Act says. The consideration under this circumstance shall be determined in an arm's length standard. That is, the price to be used shall be the price that a willing and a knowledgeable person will readily pay. So that is the arm's length standard. And this, it's cut across through transfer pricing as well. So where two or more persons hold petroleum rights under an arrangement other than a partnership, a person who calculates the assessable income shall calculate the assessable income of each person from the petroleum operations separately and calculate the assessable income of each person as if the persons were in a controlled relationship. So over here, What it basically means is that there's definitely going to be the proportionate sharing interest. So you need to take into consideration their sharing interest when you are apportioning them. And this will stem from the distribution of the crude oil. So please, the distribution of the crude oil is a very, very important aspect. You can have a question where you may have to distribute the crude oil, get to know the respective assignments of the revenues to each operator. So that will form the basis of the revenue. And then you obtain their respective expenses to the extent that when we move further, you need to be able to align it with the tax laws, whether you need to disallow or disallow before you can compute the chargeable income, before you can compute the tax. So it basically boils down to the distribution of the crude oil. In the unitization question that we just read, you realize that we were given the quantum of the barrel, the selling price per each, and then the last requirement was the statement of distribution. Even though the statement of distribution is the last requirement, for us to ascertain the assessable income of TC Petroleum Limited, I don't know if you have it offhand, but let me see, yeah. For us to be able to ascertain the assessable income of TC Petroleum Limited, honestly, you will have to do the statement of distribution first, because that would help in the allocation of the respective revenues to TC. So basically, that is what it means over here. So that is a general principle. Now let's delve into Separate Petroleum Operations Section 64 of Act 896. Petroleum operations in relation to a petroleum right shall be considered a separate petroleum operation. I believe you understand what this means. So where a person conducts petroleum operations in respect of two or more petroleum rights, the chargeable income of that person for the purpose of tax is required to be determined separately for each petroleum right. Then let's look at what a chargeable income is under Section 2 of Act 896. The chargeable income of a person for a year of assessment is, first of all, the total accessible income of that person from employment, business, investment, less the amount of deduction allowed. So that is how come I was saying that the B that says ascertain, no, the C that says compute accessible income doesn't necessarily mean you are computing the chargeable income. The chargeable income is accessible income less the allowable deductions. So please take note on the examination condition, what is expected of you. Now, where two or more persons also share the same petroleum rights, the chargeable income of each person is determined separately. I've explained that already. Then petroleum operations conducted prior to the date of approval of a plan of development with respect to a field and after approval of the plan of development in relation to that same field is called the same separate petroleum operation. But if it is with respect to a different field, then it becomes a new separate petroleum operation. So bear in mind that this concept called separate petroleum operation, even under mining, we have separate mineral operation as well, is actually backed by a term called the ring fencing. So the ring fencing is the segregation of business operations into separate income streams for accounting and tax purposes, basically implying that the cost from one operation is not allowed to be deducted from the income of another operation. So it's more or less like the matching concept, sort of. Whatever that is pertaining to this operation, that is what we do. You cannot offset, especially if an operator is having access to several blocks, for that matter, operating under several licenses. So one block could be making a loss and then the other block could be making a profit. You don't need to offset them. Okay, you match what is due them in accordance with their proportionate sharing interest in that particular block. Okay, so now let me throw this question to the class. Rory Oil an upstream company was granted the right to develop and produce oil in the West Cape 3 Point and in the deep water tunnel area. Determine how ROE will be assessed for tax, assuming revenue from each block is $10 million and $15 million in 2020. So how will ROE be assessed for tax over here? Hello, are we there?
Hello, madam.
Yeah, Mr. David, I don't want talking.
Yes, please.
Okay.
So based on what we just did, we were saying that the taxes are on the separate operations, and looking at this, it means that tax will be assessed based on the separate operations. So the WCTP revenue and also the DWT area revenue would be taxed separately.
Okay. So that's perfect. Now hold on and answer the second one for me. Let me see how this one will go. ANAD Limited and Beck Limited are holding a petroleum right in a ratio of 50 to 50. How would they be assessed for tax if oil produced in the first quarter 2020 was 80 million barrels at a price of $50 per barrel? How would you go about this one?
Okay, so I think with this two, the tax will be assessed based on ANAD limited and also the Beck Limited separately. Because when calculating the tax, computing the tax, each should have their own assessable income. So yes, the tax should be separate in this instance too.
Okay, so you realize that in the first instance, it was only one operator having access to different areas. And the second question, there are two operators having access to one area or one right. And their proportionate sharing interest is 50 to 50. So over here, there will be access for tax purposes separately, all right. But then it will be in accordance with their proportionate sharing interest 50 is to 50. Because I hope you are getting it. My namesake, your hands are raised.
Yes, please. Please,
Yeah.
in the second instance, what happens to charging the tax and later on sharing the tax expense to them in the ratio?
Okay, you are talking of tax expense. When you say tax expense, I believe you are talking about, let's say, example, corporate income tax. Is that what you are talking about?
Yes, please. The total tax that will come out of the operation.
Okay. So when it comes to tax, as per what we just read from the Income Tax Act, like Section 2 of Act 896, okay, it deals with chargeable income. So the corporate taxes, let me put it like in this case, is levied on the chargeable income. Okay, so you cannot compute the tax then after you share it, because the tax is levied on the chargeable income. Then again, because of Section 64, which talks about the separate petroleum operation backed by the ring fencing concept. So in the oil and gas sector and in the mining sector, hold on, let me get there. In the oil and gas sector and then in the mining sector, it is the ring fencing concept that holds when it comes to the computation of taxes. So you will need to first of all segregate them by ensuring each person has its own revenue, has its own expenses. You offset and then you apply the tax deductibility issues. So that's where you get a chargeable income before you can levy the tax. So as per the act, we cannot go by the method that you are saying. Please, are you getting it?
Yes, please. Thank you.
Okay, welcome.
So, Madam.
Hello.
All right. So my question is that doesn't it make a difference for the fact that I see the trial question number 2 to be one that is of a partnership nature, and for which reason the law appears to see it as one, not like where they have two separate petroleum rights, but just one, except that when it comes to the accounting method, the accounting for it, then it will be construed as one entity.
Okay, so but what you just said, you are right. But then the act also had to come to play with the ring fencing, because if you do not take care, remember it's a partnership as you just said, but it's a joint venture. So if you don't take care, we'll be assessing them for tax purposes as one. Okay.
And that is my where I have a little bit confusion.
Okay.
Now my confusion coming from the fact that if we're also not careful, there wouldn't be a difference between the treatment in trial question 1 and trial question 2.
Honestly, there's no, okay, let me come back. When it comes to end result, there's no difference. But then the means to the end result is where the difference is. So you see that in the trial question 1 is one entity, but that entity has a joint venture arrangement in the West Cape 3 Point and in the Deepwater Tunnel area. Remember, the West Cape 3 Points and then the Deepwater Tunnel area also has other joint venture partners. Yeah. So if, let's say, we are assessing the West Cape 3 Point area for taxes as one, at a point, we may not be able to differentiate from each partner and link it back to the respective entities and even to their accounting methods or issues, as you are saying. So worry in West Cape 3 Point and Deepwater Tunnel, okay, but there are other joint venture partners. So let's take a look at the respective, just that in this question, I didn't bring the proportionate sharing interest of Rory, but Rory will definitely be having proportionate sharing interest in both areas, which is covered by different tools and even having other joint venture partners. So if DRA comes and then say, oh, I want to access Rory, then we need to be able to more or less narrow down to Rory, not to the whole joint venture arrangement, by looking at Rory's proportionate sharing interest. Oh, it's 20% in West Cape 3 Point. Okay, that is fine. So if Rory has 20% in West Cape 3 Point, then let's look at the revenues accruing from there. Then we can be able to do the apportionment, even with the cost contributions and all that. Then we tailor it to Rory. Okay. Likewise, when it comes to, so you realize that in the first trial question, we are still tailoring it to Rory. Even though Rory has different, have access to different oil fields. That is the 2 oil fields. But it will be Rory, just a tax and a West Cape 3 Point, tax and a Deepwater Tunnel, because each of the areas may have different circumstances, different joint venture arrangement conditions and all that. But with a second question, it is actually pertaining to one field. Like I said in the first question, as there would be other joint venture partners in the West Cape 3 Point and then again in the Deepwater Tunnel. It is not only ROWE. Please take note of that. But in a second question, it is only one field, one right, but there are two operators in here. So because there are two operators, we need to assess them separately for tax purposes. So you then begin to narrow it down again to their respective proportionate sharing interests. So Anad will have 50, Beck will also have 50. For, maybe there could be other cost contributions. So perhaps there will be some sharing and all that. So even though it's a joint venture arrangement for tax purposes, we need to be able to narrow it down because we are dealing with the person. We are not dealing with, the arrangement for tax purposes. We are dealing with the person. And this person, the persons over here are corporate entities. So we narrow it down per the act, then we can compute their respective taxes. I don't know if I've been able to satisfy your question though. Please, are you okay?
I'm okay. Thank you.
Okay, welcome. So there's a practice note on separate petroleum operations. And this one, I took it from the practice note. But like I said earlier, I will try and collate all the documents so that you can have access to them. Okay, so this is just a brief overview from the practice note. Let's take a look at capital allowance, then we can call it a day. Now, capital allowance, we have it in two phases. Under section 14, and I think the third schedule of Act 896, but two phases in the sense that the computation of capital allowance in the petroleum and the mining industry is different from how it is computed in the other non-mining and then the non-petroleum industries. Okay, but I mostly also bring the other industries on board so that at least you know it. You need to read on it because you can't know the petroleum and mining one and then the other ones you don't know. It's not a good thing. So section 14 looks at capital allowance. Maybe some of us may not know what capital allowance is, so we know, but we may not know the difference when it comes to these sectors. Capital allowance is basically depreciation, the depreciation and then the amortization and the depletion in accounting. In tax, we call it capital allowance. That's the basic understanding. So this is what brings the differences in the tax figures. So because the accountant is having depreciation, then the taxman too is computing capital allowance. So the capital allowance at a point may be so different from the depreciation at a point, and this would bring about deferred tax issues and all that. But then when it comes to here, what we are doing, the capital allowance is granted on a depreciable asset. And there are conditions that it will be granted on. So it must be in use for the business. It's very, very important. That asset must be in use for the business. Okay, basically that's the underlying concept. There are other issues, but basically that's the underlying concept. With the general business, we have two main methods. We have the straight line method and then the reducing balancing method. So the straight line method is levied on the cost. The reducing balance is levied on the running balance. Just like depreciation, we have the diminishing balancing method and we have the straight line. Depreciation like this, depending on your depreciation policy, if it's a straight line, is levied on the cost. If it's diminishing, the same thing. Okay, just that when it comes to tax and you're computing capital allowance and it's a new business, you may need to watch out when the business started operations so that you can apportion the number of days in the year that, or let me say, the year of assessment, then you can equally apply it to the rate and then the cost as well. Okay, so when it comes to petroleum, Under section 65, we have pre-production cost, even under mining as well. So the Act says that capital allowance cannot be granted until production takes place, which means that even if production will take place 10 years later, all the costs, be it a capital expenditure or a recurring expenditure, once it is an expenditure that is incurred at the pre-production phase, take note that it will qualify for capital allowance. So we have two main pools under mining and petroleum. We have a single pool 1 and then a pool 2. The single pool 1 basically looks at the collation of all expenditure with the exception of asset expenditure, let's say acquisition of an asset, and then the pool 2 will have the assets expenditure. Okay, so we need to be able to differentiate so that we can know which ones are for the asset and which ones are for the running of the business. But bear in mind that all the cost that is incurred at the pre-production phase qualifies for capital allowance, either administrative cost or what, it is qualifying for capital allowance. But we need to take note that as tax people, when computing the capital allowance of an oil and gas or mining entity, the expenditure that goes in at the pre-production phase must not be a domestic or an excluded expenditure. You can take a look at section 8 and 130 of the Act of what a domestic or an excluded expenditure is. Then also that expenditure must meet the one principle, that is wholly, exclusively, and necessarily. And even this cuts across the deductibility principles when it comes to the disallowing and then the allowing of an expense in computing the chargeable income of a business. So wholly means that that cost must be 100% related to the business. Exclusively means that it must more or less, without such an expense, the business cannot go on, and necessarily means that it must satisfy the objective of the business. So if it is not, then we don't need to include it. Okay. So now let's take note that the pool of expenditure in relation to the pre-production cost, according to the Act, it cannot be reduced by an income of the person. Let's say in case there's a disposal of an asset. Okay. But the balance shall be carried forward year to year. But when we move forward, the same Act says that in a situation where the balance in the pool is negative by virtue of deduction of consideration from the sale of depreciable assets. So which means that during the pre-production phase, there could be a disposal. And when there's a disposal, where does it go to? Because now there's no production for us to even get an income. So you can offset the consideration from the pool of an asset. In an instance where it becomes negative and let's say production begins, you just carry the negative value to the income because more or less like the consideration has exceeded the cost. So the balance is in the negative, and for that matter, it's an income. So you can just pass it through the computation of the income. Basically, that is what it means. Okay. So here, let's take note that the capital allowance rate for petroleum and mining is 20% and it's on a straight line basis. Okay. For the rest, I would like to end here. Next week, God willing, then we take a look at it and then we'll delve into mining as well. So please, do you have any question before we end the class?